It's that time of year again. Stocks are climbing, Reddit is buzzing, TikTok traders are hyped, and everyone's asking, will Santa bring us a rally? But before you go all in, let's break down the real historical data, what it actually means, and why being careful matters more than ever. The Santa Claus rally refers to a seasonal stock market pattern where prices have historically tended to rise during the last 5 trading days of December and the first 2 trading days of January. It was first documented in the Stock Trader's Almanac in the early 1970s by Yale Hirsch, based on observations of calendar-based market behavior. Since 1950, the S&P 500 has delivered positive returns during the Santa Claus rally about 78 to 80% of the time. This rate is higher than average returns for a typical 7-day period. Over decades, the S&P 500's average gain during this Santa period has been around 1.3%. By comparison, the typical 7-day weekly return for the S&P is closer to 0.3 to 0.4%. Some years show very strong Santa rally performance. For example, the 2021-2022 period was up about 3.03%. Most studies confirm more frequent positive outcomes than random chance, but not every year sees strength. Economists propose reasons like holiday optimism, year-end bonuses getting reinvested, and lower tax loss selling after December 31st. Also, thinner trading volumes, with institutional traders on vacation and short sellers walking away for the holidays. However, these are tendencies, not certainties. That's why relying solely on this effect is risky. Let's look at why you should be careful. First, it isn't a guaranteed trade. Just because history tilts positive doesn't mean every year follows the script. In the current period, markets have shown fragile performance beneath the surface, suggesting that momentum can fade. Notably, consecutive Santa rally failures have occurred in history, which reduces the idea that this is a sure thing. Seasonal effects don't override earnings, interest rates, or macro volatility. These always matter more over the long run. So, how should you think about it? Use it as context, not a reliable predictive signal. Manage risk over getting FOMO. Set stop losses, don't over-leverage, and keep cash for better setups. Think longer term. Portfolio growth comes from fundamentals like earnings and valuations, not just holiday patterns. The Santa Claus rally is real, but it's a statistical tendency, not magic. Disciplined risk management always beats seasonal hype. Don't get carried away by Christmas cheer. Stay strategic. Thanks for watching. This video is for educational purposes only and does not constitute financial advice.